According to SSA's own published benefit documentation, every retirement check ever sent to every beneficiary was produced by the exact same mathematical formula, and virtually none of the 70 million Americans collecting those checks were ever shown that formula, told what their own numbers look like inside it, or given the chance to verify that the inputs SSA used were actually correct before the calculation was locked in permanently. That formula is not classified. It is on SSA's website right now. And once you understand how it works, what it has been quietly doing to your lifetime benefit total is something you will not be able to unsee. This update is for every Social Security recipient who has been collecting a monthly check without ever seeing the math behind it, and for anyone who wants to know right now whether their benefit reflects their actual earnings accurately or whether an error inside the formula has been quietly costing them money every single month. Earlier this week, I received a message from a 66-year-old retired office manager named Patricia from Milwaukee, Wisconsin. Patricia worked for a manufacturing company for 34 years, kept the books, managed payroll for her department, and told me she considered herself someone who understood numbers. She retired 6 months ago, and for the first few months accepted the amount that arrived without questioning it, assuming the SSA had done the math correctly. Then a colleague from her old office, same age, similar job, similar number of years, mentioned at lunch what her own monthly check was. The number was nearly $200 more than Patricia's. Patricia went home and looked up everything she could find about how Social Security calculates benefits, and for the first time encountered the phrase average indexed monthly earnings, and read about something called bend points, and told me she felt like she had walked into a room that had always existed, but that nobody had ever told her was there. She wrote to me and said, "I ran payroll for 34 years and I understand math. How did I get to 66 years old without anyone ever showing me the formula that determines what I get paid for the rest of my life?" She said, "I think there might be a year or two missing from my record, and I do not even know how to check or what it would mean if I am right." Patricia, the formula is real, it is understandable, and by the time we finish here, you are going to know exactly how your benefit was calculated, what a missing year actually costs, and what you can still do about it today. Let us start from the very beginning of the formula and build it up piece by piece, because once you see the full structure of how the SSA arrives at your monthly check, you are going to understand immediately why the details inside the calculation matter so much, and why a single error can follow a beneficiary for the rest of their life without ever being caught or corrected. Step 1 of the formula is building your average indexed monthly earnings, which the SSA calls your AIME, and this is where the foundation of your entire lifetime benefit is set. The SSA starts by pulling every year of wages you ever reported to the federal government through payroll taxes, going all the way back to your first job at whatever age you started working. It then takes each year's earnings and adjusts them upward for wage inflation, using a national wage indexing factor tied to the year you turn 60, which is the SSA's way of comparing earnings from different decades on a common scale, so that $20,000 you earned in 1985 is not treated the same as $20,000 you earned in 2005. Any earnings in years after you turn 60 are counted at face value without indexing. From that full wage-indexed earnings history, the SSA selects your 35 highest earning years, adds them together, and divides the total by 420, which is the number of months in 35 years, to produce your average indexed monthly earnings, the single number that feeds into everything that comes next. The 35-year rule is the first place where the formula quietly punishes people who do not know it exists. If a person worked for 30 years and no more, the SSA does not simply average 30 years of earnings. It averages 35 years of earnings, with 5 of those years recorded as 0, and those zeros are averaged in with full weight against the years where the person actually earned wages. Each 0 year in the calculation pulls the monthly average down, which pulls the lifetime benefit down. And for every beneficiary who worked fewer than 35 years, the gap between what they receive and what they would have received with a complete 35-year history is compounding permanently through every monthly check and every COLA adjustment applied on top of it. For someone with 32 working years, The 30 years are not minor rounding errors. They are a permanent suppression of the base number that all future math is built on. But zeros from missing work years are not the only source of errors inside the AMI calculation. And this is the point where what Patricia suspected about her own record becomes critically important. The SSA's earnings record for any individual beneficiary is only as accurate as the data that was reported to it over the course of that person's entire working life. And that data came from employers, not directly from workers. When an employer filed their payroll taxes incorrectly, when a staffing agency reported wages under the wrong identification number, when a name change created a record that could not be matched to the correct Social Security number, when a small business filed its W-2 forms late or with errors, those wages may have landed in the SSA's master earnings file incorrectly, or may not have landed there at all. The SSA's own Office of the Inspector General has documented billions of dollars in payment errors across the system, including a specific audit focused on self-employment earnings removed from the master earnings file due to processing issues. The error is not theoretical. It exists in the records of a significant number of beneficiaries right now, and most of them have no idea because nobody told them to check. Step 2 of the formula takes your AMI and runs it through a progressive benefit formula using specific dollar thresholds called bend points. And this is where the SSA converts your lifetime average monthly earnings into your primary insurance amount, which is the exact monthly benefit you would receive if you claimed at precisely your full retirement age. The bend points for 2026 are $1,286 and $7,749. And the formula applies 3 fixed percentage factors to 3 segments of your AMI separated by those $2 amounts. The first segment is every dollar of your AMI from 0 up to $1,286. The SSA replaces 90% of every dollar in this segment. That means a beneficiary whose entire AMI falls below $1,286 receives back 90 cents from Social Security for every dollar of their average monthly career earnings, the most generous replacement rate in the formula by far, and deliberately set that way to provide a meaningful floor of income for the lowest earning Americans. The second segment covers every dollar of AMI from $1,286 up to $7,749. The replacement rate here drops to 32%. For every dollar of your average monthly earnings that falls inside this range, the SSA replaces 32 cents. The third segment covers every dollar of AMI above $7,749. The replacement rate drops again to just 15%. 15 cents returned for every dollar of average monthly earnings above that upper threshold. These 3 rates, 90%, 32%, and 15%, have not changed since 1979. The bend points themselves shift upward every year in line with the National Average Wage Index. But the percentages have been constant for nearly 50 years and are fixed by law in a way that requires an act of Congress to change. According to Congress.gov's own research service, the most workers ever fall between the 2 bend points, meaning between an AIME of $1,286 and $7,749, which corresponds to average annual career earnings somewhere between roughly $15,400 and $93,000. And in that middle segment, every dollar produces 32 cents of monthly benefit. The structure is progressive by design, meaning lower earners get back a higher percentage of what they put in, and higher earners get back a lower percentage. But the formula applies with equal mathematical precision to every single beneficiary, regardless of whether they ever saw it or understood it. Here is why the bend point structure matters so specifically to Patricia's situation and to anyone listening who suspects there might be missing or incorrect years inside their earnings record. When your AIME is calculated incorrectly because of missing wages, the impact on your PIA is not a flat dollar loss. It depends entirely on where in the benefit formula those missing wages would have fallen. A dollar of AIME lost from the first segment, the 90% zone, costs you 90 cents of monthly PIA permanently. A dollar of AIME lost from the middle segment costs you 32 cents of monthly PIA. A dollar of AIME lost from the upper segment costs you 15 cents. For a beneficiary in the middle bracket, which is where most Americans fall, a missing year of earnings that would have added $3,000 to the AIME calculation, or $250 per month of additional indexed earnings, costs approximately $80 per month in lifetime PIA, which over a 20-year retirement equals roughly $19,200 in permanently uncollected benefits that nobody ever flagged, nobody ever reported, and nobody ever corrected. Step 3 of the formula is the claiming age adjustment, and this is the variable that sits on top of the PIA calculation and either multiplies or discounts every dollar that the first two steps produced. Your PIA is the amount you receive at exactly your full retirement age, which is 67 for anyone born in 1960 or later, and phases in on a sliding scale between 66 and 67 for those born between 1955 and 1959. Claiming before full retirement age permanently reduces your benefit by a fixed percentage for every month you file early. Claiming after full retirement age permanently increases your benefit by 8% for every year you wait, up to age 70, at which point the delayed credits stop accumulating. For someone born in 1960 or later, the full range of claiming adjustment runs from a 30% permanent reduction at age 62 to a 24% permanent increase at age 70. A total spread of 54 percentage points apply to the same underlying PIA, depending entirely on which birthday you filed on. The claiming age decision is the part of the formula that most seniors have at least some awareness of, because it is the variable the financial planning industry discusses most often, and the one the SSA describes in its own communications. But the AIME calculation and the Ben-Point formula are the parts that determine the base number before any claiming adjustment is applied, and they are the parts most likely to contain uncorrected errors that have been quietly suppressing benefits since the moment the first check was sent. What Patricia can do right now, today, before anything else, is log into her My Social Security account at SSA.gov and navigate to her complete earnings record. What she is looking for is every year she worked, listed with the actual wages the SSA has on file for that year. And what she needs to do is compare that list against her own memory of her employment history and against any W-2s, tax returns, or pay stubs she still has from earlier in her career. She is specifically looking for years that show 0 or a number dramatically lower than what she remembers earning in that job, because either of those could indicate an employer reporting error that has been depressing her AIME and therefore her PIA for the entire time she has been receiving benefits. If she finds a discrepancy, she contacts SSA at 1-800-772-1213 and requests a correction with supporting documentation. The correction raises her PIA going forward from the date it is processed. It does not recover the months of underpayment that already occurred, which is why doing this check as early as possible in retirement matters so much. But every future check from the correction date forward will be permanently higher by the full dollar amount the formula recalculates. One more piece of the formula that Patricia and millions of other beneficiaries are leaving unclaimed and almost certainly do not know about relates to the benefits that are calculated based on someone else's PIA rather than the beneficiary's own. If Patricia is or has been married, her spouse may be entitled to a spousal benefit of up to 50% of Patricia's own PIA, paid on top of Patricia's check without reducing it by a single dollar. If Patricia's spouse has passed away, Patricia herself may be entitled to a survivor benefit of up to 100% of her spouse's benefit, if it is higher than her own. And the survivor benefit calculation uses the deceased spouse's full benefit amount as its base, including any delayed retirement credits that were earned before death. These derivative benefits exist inside the same formula, and they are calculated off the same AIME and Ben-Point structure, which means every error in an earnings record and every claiming age decision compounds not just into the worker's own check, but into every benefit built on top of it. Checking whether a spousal or survivor benefit applies to your household takes one phone call to SSA at 1-800-772-1213. And for many couples, the answer is a meaningful monthly increase that no one had to earn any additional work credits to receive. If you are not yet subscribed to U.S. Pension Insight, please hit that subscribe button right now. It is completely free, and this channel exists so no senior gets paid $1 less than what they are actually owed. The formula in 3 steps. Your AIME, 35 highest wage indexed earning years, divided by 420 months, with every missing year averaged in as 0. Your PIA, 3 replacement rates, 90% up to $1,286, 32% from $1,286 to $7,749, and 15% above that, applied to your AIME using 2026 Ben points. A missing year of earnings in the middle bracket costs 32 cents of monthly PIA permanently. Your actual benefit then adjusts by claiming age, minus 30% at 62, plus 24% at 70. Check your earnings record at SSA.gov today. Patricia found 2 years from early in her career showing wages far below what she remembered earning. She has a correction appointment with SSA this week. She told me, "I kept books for 34 years and never once thought to check the books they were keeping on me. I am checking now." That is exactly why this channel exists. Stay subscribed.